Good morning, Platinum Top 50 San Antonio, and welcome to Building Wealth Outside of Real Estate. You guys are in for an awesome program today, one that actually we did in Austin a few weeks ago, and like Scout's Honor had the highest remarks, the most number of chats. We got so many emails from agents thanking us for putting on this content. So it was one that we thought, you know what? If we hit it out of the park that much for Austin, we've got to bring this to San Antonio. Because we know that right now, agents are comfortable investing in real estate. It's what you know, but there's a lot of other tools and resources to be used to building that long-term wealth that we all desire. And we also know that right now is a time of opportunity, right? There is wealth accumulation to be had. There is, opportunities out there right now. And so, again, just feel like this content is really timely. It's on point, and I'm really excited to bring it to so many of you today. So building wealth outside of real estate, we're going to learn about different products, everything from how you can use life insurance policies as a wealth accumulation tool, different ways that you can save for college. We're going to be talking about different retirement that you can set up as an independent agent, as someone who's self-employed. So all of that to come. But as you guys know, this program, like almost everything from Platinum Top 50, is underwritten through wonderful and strategic business partnerships that we feel so fortunate to have. And today is no different from that. So today's program is being brought to you by Meritage Homes. And it is my privilege. I would love to bring up Jessica Goldberg. She is the marketing manager for Meritage Homes. So Jessica, how are you? Hi.
Hi, I'm good. Very good. Now we've got, so since we're talking about building wealth and saving money, Meritage Homes is setting the standard as far as that goes. So, I mean, we've got energy efficiency built into every single home that we build, and it is saving your clients money. And then on top of that, we've also got some spec homes out there across San Antonio that are getting you guys 6% commission. So we are definitely trying to build wealth for everybody here as well. And one new opportunity that we have for you guys and for your clients is going to be at Myers Landing, which is going to be our newest community, the latest and greatest in New Braunfels, actually. So we are actually making a stand in New Braunfels, and we've got an amazing community opening there, and Laura Garza is our sales rep out there. And she is going to talk a little bit about Myers Landing and why New Braunfels is so amazing.
Hi, everybody. How's everybody doing this morning? Yes, we're excited to be here in New Braunfels. I've been with Meritage personally of almost 8 years. So time flies when you're having fun, that's for sure. But Jessica's amazing. She's helped our team grow our business, which is key, and take care of our realtors. Because our realtors are definitely our key to success. I mean, without you guys, I mean, there's no way we'd be in business. But we are excited to be here in New Braunfels. I am super excited because I live 5 minutes away, so my drive has been cut tremendously. My husband likes that I can possibly come home for lunch. I don't know about that, but we are just, if you're familiar with the New Braunfels location, we are just right outside of, we're kind of close to Buc-ee's. Everybody knows where Buc-ee's is at in New Braunfels. We're close to the Creekside. Yes, everybody loves Buc-ee's. But we're right there in that Creekside location. So it's a little past Resolute Health Hospital. And we are a very small community. It's only going to be about 230 families. So it's not a big community. It's got a really nice country feel. There is a lot of just quietness out here. And a lot of homeowners like that it's very quiet, and you're still close to all the hospitals, the groceries, and all that fun stuff. And our price point for New Braunfels is absolutely amazing. We're going to start probably in your mid 250s and go up to about 300. I have right now about 9 inventory homes that officially have started. And we are a Live Now product. And if my realtors aren't familiar with that, the Live Now product is a very easy way with Meritage Homes, so your clients don't have to stress about the whole design center process. The build process is already stressful enough for our homeowners. This takes away all of that, because you'll have the buyers that freak out sometimes at design center. So we're very transparent with our pricing. And we're the same overall Meritage quality that you see in all of our homes. So we still offer the spray foam insulation that everybody loves, and that sets us apart from all the other builders. But we'll have anything from about 1,500 square feet to about 2,200 square feet. 3 to 5 bedrooms, and we have this cute little craftsman country style look to our homes that aren't your standard cookie cutter homes at all. So we're excited to be here. We're excited about the location, and we look forward to doing business here and setting Meritage, or putting Meritage here in New Braunfels when we haven't been here for so long. We look forward to those realtor relationships, and hopefully do some business and get your clients into some homes and take care of them. I know that we pride ourselves on customer service, and we know that taking care of your clients is a huge importance before and after the sale. So get with me. You'll have my information. Bring your clients out here. I'll be more than happy to show y'all around. So and then, this is kind of a preview of the model, it's super cute. It's about a 2,000 square foot home, 3 bedroom, 2.5 bath. It's got a cute little kitchen. Now, all these colors that are in this particular home are standard. And this is what Meritage is known for, is the spray foam insulation. You see that the temperature is the same temperature as the rest of the home, which is key to those first-time homeowners that don't know about insulation. I made the mistake of buying my home 20 years ago and have poor insulation, so it's hot in my upstairs when I'm getting ready, and that's never fun. Makeup's melting off and all that. No, you don't want any of that. But this is our cute little model. We're excited to be here. Y'all are more than welcome to holler at me with any questions. I'm happy to help any way I can. So, and thank y'all for hosting us, and thank y'all for being here. We appreciate y'all's business and everything y'all do. So
Awesome, Laura. That was so great. So just a quick little recap. So Laura's community, Meyer Landing, not to be confused with another Meyer in Austin. Meyer's Landing, this is the one by Buc-ee's. Price from the mid 50s to 300. She has 9 inventory homes. And Jessica mentioned a 6% commission. So we'll make sure that we send all of you the follow-up information. We'll get you connected with Laura. We'll share all the promotion and inventory information that we have. So thank you so much to Meritage Homes for just being great partners of Platinum Top 50. The agents I know are grateful for you guys underwriting this program for them this morning. So thanks so much, and we'll hear more from you later. All right, can I cue up Tom Valenti, our program speaker today? And let me start by just kind of explaining how I know Tom. Because as we were preparing for this conversation, I thought it was great. He wanted to make sure that, I mentioned that we don't have any sort of professional relationship in terms of, him, being a wealth advisor, money manager for me personally. In fact, I was introduced to Tom through Mario Galdes. Shout out to Mario over at Legacy Mutual Mortgage, who have a wonderful working partnership. And so this is just a conversation from 2, business partners, not folks who kind of commingle and do personal financing with that. So I love that Tom wanted to make sure that was, put out there. Tom, will you introduce yourselves to our audience?
Yeah, thanks, Amber. Appreciate it. Excited to do this again. I hope we get the same type of response that we did with the Austin Network. And for everyone that's listening, I'm going to do my best not to bore you. But again, I'm Tom Valenti, Platinum Wealth Solutions. I've been a financial advisor for about 8 years. We're a family-owned and operated business. We have offices in 6 different states. And every day up until this stay-at-home partial quarantine, I worked alongside my dad, my brother, and sister at the office, which is kind of a neat dynamic. And hopefully we can get back to that here pretty soon. But I just have a real passion and dedication just to get to know people and understand, what's important to them and what are their challenges financially, and then do whatever I can to alleviate some stress and anxiety in their life and give them as much clarity as possible when it comes to their money.
Well, Tom, I don't know that building wealth will ever be a boring topic, especially with this group of top producers that's interested in on the call today. And let me just
Well,
say,
Amber, I don't quite have the charisma that you have, so I'm a little fearful of that.
Well, I've had 10 years hosting live events right under my belt, so I became pretty comfortable with that. Although, honestly, talking in front of a camera is more challenging than it is for me in front of a live audience. But I'm doing my best, that's for sure. And why I love this content is because I have personal experience with it. My wealth advisor, I got introduced to her before I had children, before I was married. And so I have now 12, 13, years experience building wealth outside of real estate. And I was building wealth before I had wealth to build, right? So I feel like I've got a really good foundation. And so it's just a topic that I'm pretty interested in.
Yeah, Amber, I think that's awesome that you did that type of work, at a young age, and that's not normal. Most people don't seek professional help until they have accumulated wealth, whatever that number may be, or they've started a family because of that additional layer of responsibility. So I'm really curious what motivated you and inspired you to take that action and start that great work so early on.
Well, interestingly enough, my boyfriend at the time, now husband, he doesn't mind if I air his business online without him knowing. He was getting out of a couple of years in the NFL and was lucky enough to have accumulated some amount of wealth, not huge wealth, but some amount of wealth. And we could go into another time, for example, right, that the NFL pays their players their entire salary during the season. So imagine being a young kid and your checks are huge. It's a weekly check. And then you don't get one for 45 more weeks. So that was a lesson to learn as a young kid. So he was exiting the NFL, had a little bit of wealth accumulated, and was going back to school. And I remember saying, look, this has to last as long as it can. We need some help. You need some help. We need that together. And so that's kind of what prompted us. And let me just tell you, the relationship that I have with my personal advisor is probably one that you have with your clients, which it is personal. I mean, she's one of the first to know when we're having a baby. She's one of the first to know when we want to, we've, recasted our vision and goals as a couple, and how can you help us get here? And so it is a very personal experience, personal relationship, and one that if you don't have one, I just cannot encourage you enough to put that on your list as something to explore, because it is remarkable. So let's go into some of the wealth building tools in the toolbox, right? Because Tom, when we looked at building long-term wealth, we know real estate is one of those tools, but what are some of the other key tools that we should be knowing about?
Yeah, absolutely. I'm going to talk high level on a couple of different things today. I'm going to switch over and just share my screen here very briefly. But a diversified, balanced approach is always going to be the best. And, there are things out there like 401ks and 403bs, which most of us on this today probably do not have, because that's offered by an employer. And when you become self-employed, you don't have access to that, or maybe you had one kind of from a previous career. But then because you're self-employed, you can have a SEP IRA, an SEP IRA. We're going to talk about that in some more detail. And there's Social Security and stocks and bonds and mutual funds, obviously real estate. And then there's tax-favored resources such as life insurance, municipal bonds, pay tax-free interest. Now, the interest isn't very good right now, but it is still tax-free. And then Roth IRAs can still be a very, very good benefit. And I'll say it about fixed and variable and indexed annuities. There are annuities out there that are really good. However, there's a really negative connotation with them. And so it just kind of depends on the situation, but everything has its purpose and everything is specific to your situation. But most likely for everybody, 2 or 3 of those applies to you at this time, and it's just about being aware of it.
Perfect. So let's break some of those down. And to our audience, I want to point out that at the bottom of your screen, you will see a chat bubble. So you can open that and display a chat on the side of the screen and use that to communicate with me or the other attendees. So we have that chat feature. Also, there's a Q&A feature. So I encourage you, as we are going through this, if questions come to mind, send them my way then, and I will save those questions and filter them and get them to Tom at the appropriate time. So just want to encourage all of you to use the chat and the Q&A. All right, Tom, let's go into life insurance, because for me, life insurance has been one of the key ways that we have, one of the key tools that we have used to build wealth. But it's really confusing and complicated. Like, I'll try to explain it to friends of ours who are, buying, an inexpensive policy that will last for a year. And they're really using that in case of, the unexpected happens, right? So that's their mind frame of life insurance. And I'm over here telling them how we're using life insurance to save for retirement, and how we are putting a lot of money into life insurance every month. So can you break down kind of some of the differences between those two and help us understand how life insurance can actually be used for wealth accumulation?
Of course, there are 3 main types of life insurance, and there is no right or wrong. It just depends, of course, where you're at financially and what you're trying to protect with your family or your business. And so there, again, I'm going to switch over, but the 3 main types of life insurance are term life, universal life, and whole life. And so term life is what most people know. It is basic coverage for typically 20 years. If you pass away in that 20 years, your family gets a tax-free death benefit, and then it expires after that period of time. There's no equity, there's no cash value in it. This is what most Americans buy. This is what's promoted typically on TV, and it definitely serves its purpose. But then on the other side of the spectrum, think of term life over here, whole life over here, and then universal life kind of being in the middle as a hybrid. On the other side of the spectrum, at the bottom here of this slide, is whole life. It has cash value that accumulates. Your cash value grows based on the dividends that are credited to the account based on the insurance company's profitability. The insurance company's profitable, they pay a dividend to you, and that credits your cash value, so you build an equity in the policy. Costs more because it's there for permanent life. It doesn't expire in 20 years. If you die at 100 or 105, it will be there. And so that's, kind of what you pay for type of thing. And then in the middle, there's universal life. It works the same, but your cash value is credited not based on company dividends, but going to be based on either stock market performance, which, as we know, can be up and down, or interest rates, which are low. So you might not get them as much guaranteed growth in that, but it's still a great way to have your insurance coverage and to build some cash value down the road for retirement. I'll also say that the reason whole life is the most expensive is because the insurance company that offers that says, we're going to pay you a guaranteed dividend of 3 or 4%, but we could pay you a dividend of 6 to 8% if we're profitable. So if they're going to be on the hook to guarantee something, you're absolutely going to pay for it. And so it just kind of depends on, okay, well, what do I buy? Do I buy all 3? Do I buy 1? Well, that's client specific, of course.
Awesome. And Jenny, I see your question for the Q&A. That's great. Thanks for sending that. We'll get that answered here. Let me see if I, can't answer that though, and might kind of jump back to Tom. So Tom, the one my friends are using where it's, inexpensive and it's just to cover the year in case the unexpected, that would be term. My husband and I, we've diversified our life insurance, in that one of us has a UVL, universal life, the hybrid, and one of us has a whole life. And so I think for mine, it was predetermined that, okay, if I was maybe, 24 when I started that product. And if I had told her I wanted to retire at 55, so we had that much time to play with. And then we played with the numbers, and it was basically like, okay, if I commit to X amount a month for 12 months or 12 months, 12 years, 15 years, I don't remember. Then if I didn't touch that money, the compound interest would be paying me a huge dividend when I wanted to retire, right? And so it's the idea, it's the compound of it, that's one that becomes another revenue source for me in retirement, not to fully fund my retirement, but as a mailbox money for the revenue source. In addition to that, here's the thing, Tom, that I don't think most people understand, and please correct me if and when I'm wrong, is that the universal life and the whole life, the cash that you put in is liquid. And so that was for us a big thing to say, okay, you know what, I can make that commitment, because if I needed to pull that money out for some life emergency, that I had access to it. It wasn't like it was tied up in the market and I was going to be penalized, right? You're not penalized if you access your cash value. Is that correct?
Typically, yes, you have access to a portion of the cash value. The longer you keep it, then you have access to all of it. And typically that point is like the 8 to 10 year mark. But in the first couple of years, there's typically some money that you can get out of it in case of an emergency. But just like most,
you pay it back at like a low loan rate, right? Like I remember, like we were buying a car and we borrowed from our policy to then sell that car, and we paid it right back because there was a loan saving versus going through traditional financing. Is that correct?
That's correct. That's correct.
Okay, so I did learn something.
And all that money that builds in there, your cash that builds inside the policy grows tax deferred. And then if we do it right, it comes out tax free down the road. So a huge benefit there, especially for the folks, that are on this call, successful real estate folks, higher tax bracket, tax-free income is very good.
And I remember, she was, my financial advisor was explaining this to me, and she would say things like, now keep in mind, your 30s and 40s, even like 50s are your prime income earning years. And so we want to set this policy, right? Our game plan, if you will, is that we'll start to draw out from that life insurance policy. We'll start to draw out when we're in a lower bracket, when we've retired. And so that's another like little tip and trick that I just remember her telling me many, many times. So let me ask this question from Jamin Scott. Thanks, Jamin, for writing in. He says, what about universal index life? Or is that the same as universal life?
It's the same. It's on a universal life chassis essentially, but because it's indexed, that's meaning how the cash value will grow. So index means it will track.
Meaning it's in the stock market.
Variable would mean stock market. Index means some stock market indice participation, but they're going to cap you, which those can be really good solutions for people. But if the market did 15 or 20%, your cash value might only be credited at 9% because they're going to cap you on that. Here's the big difference. Index means if the market tanks, cash value loses 0. And then so you're giving that up, where the other, well, I could make 25% my cash value, but if the market drops 20, I can lose that too. So index floor of 0 and then a cap. So they're giving you, there's a smaller threshold there for making money.
That's awesome. And that's probably also why, like with my husband and I's policies that we have on each other, one is in the market and one isn't. One's more conservative. So as the market fluctuates, we don't have to ride that out with both of our policies. So that's a great one. All right, let's go to college savings because a couple of reasons. One, that usually drains people's banks. They're trying to plan for it now. And also, as I'll explain to you guys here in a little bit, life insurance is the tool that we have chosen to help fund our children's college. And like for so many people that just like, huh, how, why? So it's like a nice kind of roll in going from life insurance as an adult to the how we use it for children. So let's start with college savings. And can you tell me about some of the different ways and products and tools that folks have to save for college?
Yes, absolutely. There are three main ways that people save for their child's college education. And it's Section 529, that's the IRS code, 529 college savings plan. That's what a lot of people are familiar with. Put money in after tax. It's tax-free, should use it for college. And now actually in most states with the tax law change a few years ago, if there's a child in private school, K through 12, you can use that money tax-free as well. So just more flexibility, which I think is good. And then the other would just be a regular brokerage or mutual fund account. Now there's no tax advantages with that, but it's incredibly flexible should that child not pursue a full, college plan or decide they want to start a business, or you want to give them money for a first home or whatever. You can use that in just a regular brokerage account. Where in the 529, if you don't use it specifically for education, there will be a 10% tax penalty applied to it. So that's not the best. And then the last one that we've talked about a little bit is using the cash value in your life insurance to take that out. And there's no stipulations on what you can do with that money. So a lot of flexibility with that. I would say if you give that one 15 plus years to really grow and do its thing and to kind of bake, that can work really, really well. If you're going to use this a life insurance policy to help save for a child's college at age 14 or 15, even 12, it's maybe not going to be the most efficient strategy. But if you start while the child's pretty young, it can be a nice piece of the pie to help with all of that.
So let's start from the top there with the 529. Is that the same as the Texas Tomorrow Fund?
It is not the same. And the main difference is the 529 will allow you to pay for college anywhere in the United States.
Okay.
And it's gives you a lot more flexibility. So computer, tuition, room, and books, where the Texas Tomorrow Fund ultimately is prepaying the tuition credits specifically for your hours that you're doing in a semester.
Okay, and so let me ask this. What if the child decides to go to more of like a vocational school?
You can use the 529 for that now.
Okay. So if they wanted to go anything from, I guess like culinary school would be an example, right? Like that's covered there, and then tuition, room, and books.
It did not used to be that way, but yes, that 529 money can be used for that now, tax-free.
Okay, so what happens if your child gets a scholarship? What happens to that money then?
So let's say they can take money out in the amount of the scholarship, and there's no penalty. So if the scholarship's $10,000 a year, you can take out $10,000 from your 529, and there's not going to be any penalty to that. So the IRS has some common sense in this case that they don't penalize people for having athletic or smart children.
Got it. Okay, so correct me if I'm wrong too, but isn't this a transferable product? Like, in other words, it doesn't have to be assigned to just one child if you have multiple, or grandchildren if you have multiple. Is that correct?
That's correct. All you do is you just change the beneficiary of it, and you just can transfer it down the line. If one child doesn't use it, you can just transfer that money to them. You can transfer it to the next generation or a niece or a nephew. So you can always do that. And a lot of grandparents actually help put money in, which is kind of nice.
Right.
So the big thing with the 529 versus like a lot of times banks will push UTMAs or transfer to minors accounts. The problem with that in the state of Texas at age 18, that money is theirs if they know it. That's scary. In a 529, the parent is always the account owner. I mean, grandparent could be the owner, but the child never gets access to that money. Okay, so I think that's a big deal.
No, that's huge. That's huge. What if I am a a grandparent who wants to consider this and I have multiple grandchildren, would I just start one account, or would the advice be to start account for several of them, maybe one with each one of my children or something?
Yeah, so sorry, I did not explain that thoroughly. The recommendation would be to start 1,529 per child,
Per child.
because
Okay.
you can only list one beneficiary on each one.
Okay.
That's
So now-
much more efficient than having it all in one and then having it all for the oldest. That's just typically not the best way to do it.
So you can't have one account and then give 10 grand to this one and 10 grand out of it to this and 10, it's just on the beneficiary. Okay, thank you for clarifying.
Correct. Yes.
So let's go into the idea of universal life insurance as a college saving tool. And again, I'm totally fine being transparent with, how that's been the tool that we have chosen to go with, because I think it's incredible and I think a lot of people just don't know about it. So at the advice of our financial advisor, we took out a life insurance policy on our children as soon as we could. So about 6 months. And for a couple of reasons, like Tom said, if it has 15 plus years to grow, it can accumulate and compound interest in there. Additionally, there is some liquidity to it. So if we needed to access the money that we put into it for any reason, we could. Furthermore, if they don't go to college or get scholarships, or if she even said we could use this to buy, their first car, we could use this money how we want. Now, in our mind, we've created a bucket that this is for college. But if we want to gift them a Europe trip for graduation, we can pull it from that. So basically for us, we took out a policy for each one of our children, created a bucket for them. We are funding that every month to be for college, with the flexibility that we can access that cash when we need to, and we can use it how we want to. Furthermore, and this is the thing that was really the clincher for us. One is that, God forbid, one of my children were to get sick, right? And you never prepare for the unexpected, but God forbid that were to happen. Our policy, we can access some of that death benefit while they are still here to give them quality care in terms of, quality care they need if they're terminally ill. And so that for us was going, okay, there's nothing else out there that offers that. So am I right in saying, is it all of those, universal lives on a child will allow you to access some death benefits, or is that just a certain rider, or is that on some of them?
It's often there's some access to it, and then some insurance companies offer enhanced policies or an additional rider for a very low cost to give you even more money to help pay for care. So it's not a across the board kind of thing, but if you're doing appropriate planning, it's a pretty good thing to add just in case.
Yeah, so that's what it was. It was a really cheap rider to put on there. And then, lastly about this for us, because initially, it can be kind of not morbid, but it's weird. Like, why would you put a life insurance on your child? Like, it just doesn't make sense logically, right? But it was all these things that stacked up that said, well, that kind of makes sense actually. And another big piece for us was the idea that this was a legacy piece. Like, we don't have generational wealth, right? Like, it's not and we want to create generational wealth. We want to create that legacy for our grandchildren. So talk about thinking down the road, this idea that this policy is a legacy gift to our next generation was something that we just weren't finding in the 529 or in any of the other like traditional ones. So Tom, let me ask, since you have young kids, how are you kind of planning to fund their college?
Well, I actually don't have kids yet. I'm actually working on that right now.
Okay, all right, nice.
But I have already planned. I have quite a few life insurance policies on myself and my wife right now that we are stuffing money into. Some of that money will be used for future college.
Wait, can I pause you? Can I pause you real quick? Because
yes.
I want to reiterate this point. You said stuffing money in, and like we use the same thing, right? We want to max fund these policies every year, even if we have a window of how much we can. Our goal is to max fund those policies because, like Tom said earlier, it's tax-free in and it can be tax-free out. So I just wanted to like reiterate that point. So
Yeah,
sorry.
and
keep going.
buying it young when your cost of insurance is low makes sure that the cash can grow as quick as possible, because it's not getting eaten up really by additional insurance fees and costs inside. But yeah, I started a 529 plan 3 years ago with no kids, just to try to get a head start, because I think a 529 plan is a good thing to do, but I don't want it to be my only strategy, because I want to have a lot of kids. My wife is one of 7, and God knows how much it's going to be in 18, 19, 20 years to put your kid through college. And if they decide they want to go to Stanford or Notre Dame, I want to be able to say, you can do it.
Right.
And maybe when we get there, that won't be reality. I won't have the money. I don't know, but I'm going to do whatever I can right now to make sure that I create that future possibility for my children down the road. So Amber, it might also help if we go through one of those examples on the universal life to show kind of how it can be an additional legacy tool.
Absolutely.
Along with accumulating.
Yep, let's do that.
All right, so there's a lot here, but I think it's so important because people don't understand. Okay, I can speak term and I can speak universal life or whole life. I can do that on a high level, but let's get into the numbers of the difference between the two. Here is $1 million 20-year term for a 40-year-old female. It's temporary coverage. It's going to be less than $500 a year in premium. That is pennies on the dollar. This is $1 million universal life. It's going to be $14,830 a year. So $15,000 a year premium in, which means at the bottom you will have put over 25 years, $370,000 into the policy. But you also, in 25 years, will have $786,000 projected cash value that will be tax-free. You can use it for whatever you want. And on the far right, over here is a permanent death benefit of $1.6 million that continues to grow, that will never go down. Now, if you took out $600,000 in cash value and you have a $1.6 million death benefit, it drops dollar for dollar. But you still have $1 million of life insurance to pass on to family. So it's a really neat vehicle. If you play by the rules and you fund it and you give it time, it can be a really neat tool for people. So I think it's really important to see those numbers.
Yeah, leave that there. So again, I'm just, breaking it down for folks that may be seeing this for the first time. So, you get with your financial advisor, you put in your age, you put in your target exit, you talk about your income level, what number you're comfortable putting in. And so at this example, if someone was 40 years old and committed to paying $15,000 a year for 25 years, I mean, they will have spent essentially $370,000, but their value is almost double that.
Yeah.
And on top of that, if God forbid something happened to you, look at what you've created in terms of a death benefit to pass on to a loved one. You just don't find that in any other kind of mutual fund, stock invest. Like, you don't find that there. So I love that example. Thank you so much.
And the key point here is that the cash value, you can say, well, I can make more money if I just invest it in a mutual fund. Well, you might, or you might have it in a 401k. But the thing is that there's going to be either regular income taxes or capital gains taxes. And so since this is all tax-free, your money actually goes further. Like $800,000 tax-free is going to be equivalent to like $1.2 million taxable. And so it's really key just not to look at the numbers, but know all the variables that go into that.
All right, so I have a great question that's kind of on track with what we're talking about now. So, hey, Karina, her question is, can you re-explain which life policy is tax-free in and tax-free out? And she says, trying to figure out how this works. If someone makes $100,000 a year, for example, and puts $20,000 into a policy, does it reduce your annual tax liability by $20,000?
Unfortunately, no. Funding a life insurance policy is after tax money, not before. And so it does absolutely nothing to help your current income tax burden.
Okay, so can you re-explain which policy is tax-free in and tax-free out?
The tax, your whole life and your universal life policies will be tax-free out. So down the road, when you take that money out for you, it's tax-free. It's not really tax-free in.
I think I misspoke when I said that. So that's why I'm so glad. That was a great question. And for you to to clarify. So yeah, it doesn't reduce your tax liability by what you put in, right? It's after tax money.
Correct. But if we want current tax savings, that could be a SEP IRA, which I know we're going to talk about.
Exactly. But it is tax-free as you pull it out, whether you pull it out 10 years from now or 25 years from now. Is that correct?
Think of it this way. You'd rather, in my opinion, you'd rather pay tax on this little seed versus the big grown crop. And so you're paying a little bit of tax right now to have the big grown crop down the road tax-free. A lot of people flip that. It's really not the right way to do it. It's like buying a house at $350,000 and then selling it at $275,000. It doesn't make a whole lot of sense.
That's a great visual. And yeah, because we have another question kind of about IRA, which you're right, that's kind of our next segment, if you will. So, you know, we've talked about life insurance policies, we've talked about college savings options, and now let's go into some retirement accounts. So, you know, can you kind of talk us through what that next big piece of the pie looks for in terms of building long-term wealth?
So for real estate professionals, typically what we recommend, in addition to potentially life insurance as an investment tool, is either a SEP IRA because you're self-employed or a Roth IRA. And there's some key differences there. A SEP IRA is going to be pre-tax. You don't have access to a 401k. So you're going to be able to put in $55,000 pre-tax should you have the income to justify that. Which, I mean, I think it's best to try to have a hybrid approach. Some people are getting hammered on taxes and they just want whatever they can have right now to lower their current income tax burden. Well, the SEP IRA will help them with that. The issue and the downside of a SEP is you can't touch it without penalty until age 59 and a half, which for some people they say, well, I don't want to wait that long, or whatever their reason may be. That ties up the money a little bit. And you can invest it in mutual funds and stocks and bonds and index funds and all kinds of different things, as you can with a Roth IRA. So I want to make it clear that a SEP IRA and a Roth IRA, those are not investments. It's simply the wrapping, and then you put the investments inside of that. So with a Roth, anybody who has earned income or who has a spouse with earned income can put $6,000 or $7,000 a year into a Roth. The reason it's only $6,000 or $7,000 per year is because it's a great deal. And the IRS and the government.
What do you mean by great deal?
Great deals. It's tax-free here. The bottom, second to the bottom bullet point, tax-free. So when you go to retire at age 59 and a half or later, all tax-free.
So that is tax-free in, tax-free out.
It's after tax. You don't get a tax deduction on the Roth IRA, so it's not. So it's I wouldn't necessarily phrase it as tax-free in. Okay.
I guess pre-tax is the thing that throws me off. But again, this is why like we have people like you to help. Educate.
Yeah. So it is confusing. So think of pre-tax, anything pre-tax, before tax. That's when I say I'm putting $20,000 into something. And if it is pre-tax or before tax eligible, you take that dollar for dollar off of your taxable income on your 1040 tax return or whatever, however you file your taxes. If it's after tax, you don't put anything on the tax return because you already paid taxes on it. So you're just not taking the deduction.
Got it. Okay, that's what's throwing me off. Okay.
Yeah. So the reason you can't put $25,000 a year into a Roth IRA is because the tax benefits down the road, and the IRS and the US Treasury doesn't get their tax revenue from it. Like you could put $100,000 into a Roth IRA, and then in 15 years, if it's 500,000, that's $400,000 of tax that they never got their hands on.
Perfect. I love that. And you guys keep those questions coming in, and I promise we've allotted time to get to them. So this is all perfect. So let me frame up for our audience, because again, I am not the professional, right? So I feel like I can relate to the questions that they may be having. And also I can just talk to from my own personal experience. So first for us was life insurance policies on husband and wife to make sure our, house and livelihood would be maintained. Okay. Then we went and got them on our kids, college savings, etc., like building a legacy tool. Then the very last piece of pie for me was going into an IRA. And my financial advisor kept saying, hey, next step is this, next step is this. And I've only done it once. And you'll have to help me remember if it was a SEP or a Roth IRA. But basically, as a company owner, okay, I have predetermined that as a benefit for people being employed, after 3 years of employment, they are fully vested into our retirement plan, okay? And look, people are recruiting right now. There's a lot of high quality people out there. So having a retirement plan as a benefit to employment is huge. Ours is after 3 years. What that means is if it's paid out the same percentage based on your salary. So if I want to go and put in 10% into my retirement account based on my salary, I legally have to match that 10% for every one of my employees that's vested. But I know that she also kept explaining to me that as a business owner, this was something that would benefit me too, in terms of like the tax advantages there. And it's a benefit to pass on to your employees. Now, I'm not obligated to make that, right? So this year, we might not be contributing to our retirement plan as a company. I have the flexibility of deciding, yes, I'm contributing, no, I'm not. Also, at what percentage? I know ours at a max fund would be 20%. So 20% of salary is like a goal that we could shoot for, but I can also take that down to 5%. So is that true for the SEP and the Roth, or is that just one of them?
What you have is a SEP, and that's absolutely true for the SEP. The Roth IRA works differently.
Okay. So if I wanted to go and do a Roth because we weren't going to hit the 20%, do I have to do that for every employee that's vested, or can I just put that for myself as the business owner?
Just for you if you want to on the Roth.
Okay. That's interesting. So there's, again, diversification. What I love is that within every category we've talked about, life insurance, college savings, retirement, the suggestion is to be diversified within those categories, right?
You've done a great job of it, because it's a fantastic vehicle as life insurance is in many ways. It's not the only thing, and it's not the best thing for all solutions. So you said, that's great, I'm going to do that. And then you set up the SEP IRAs as employee retention to provide more value to them, and then say, well, my business is pretty good and I do need a little bit of a tax deduction with the business. Let's do this. And I can save for my future retirement all in one plan. So I think it's great that you have done that. It's really unique that you've taken such action on that, but that's just a credit to you.
Thanks. Well, it's a credit to me at least recognizing that I wasn't the professional there and seeking out someone who I can trust and who can advise, someone that does what you do. And I love that your company is like multi-generational, multi-family. Like, just as a business owner myself who started working for my father, like that means something.
Yeah.
And I really love that. All right, let's get to some of these questions. What investments are best for someone about 50 years of age that might have a little less time to kind of accumulate that wealth?
It depends. I think you look at SEP and Roth IRA first. You analyze your life insurance scenario of where you're at. Do you need as much life insurance? Maybe you start planning for long-term care insurance at that point. If you ever need assisted living or home health care, mid 50 to 55 is actually the most optimal, cost efficient time to do that. And you can bundle that into your life insurance policy. So I would say at that point, depending on what you're looking to put away and invest, you probably want to do a Roth or some type of brokerage account and invest in mutual funds in a kind of a balanced approach, not too aggressive, not too conservative, kind of a hybrid right in the middle.
Okay, that's great. Is it true that the IRA can hold real estate in it that funds the college? So the insurance is all cash contribution.
The insurance is cash that you put in. That's correct. You can hold real estate inside of an IRA. You can do that. It's a little bit hairy. Not a lot of companies will not do it or offer it because it's kind of a mess. You need a good CPA to be able to handle all that, but you could ultimately use some of those proceeds to help pay for a child's college education. It's not typically a route that we recommend. Our firm broker doesn't even offer that. I think there's a bank in Austin. I'll have to get back with you if you want information. And there's also a company named Midland, and they offer that type. That's their niche. That's what they do.
Awesome. But you'd always, to me, again, I would go through my financial advisor to help make sure that all that's set up appropriately. So great question. I didn't even know that was there. All right. Aside from SEP IRAs, what other investments can you put pre-tax earnings into to bring down your current tax liability?
If you're self-employed, I'm assuming.
Yeah.
You can do a traditional IRA, but there's not much of a benefit in that because a traditional IRA is the same thing as a SEP IRA. The SEP just says you're self-employed, so you can put more money in. That's ultimately what it is.
So
you really only two avenues there, really.
Okay, to reduce your current, yeah, I want to pay less taxes. Me too. Well, pay less now than later. So for that, it's going through an IRA.
Correct.
Awesome.
But if you want to also look at, say you have a spouse that's got a job, then a 401k is offered, max that out at $19,500. If you're over age 50, you can do $26,000. That's all pre-tax money you could put away. So look at it as a household deal, as far as tax savings as well.
Is there, walk me through how you can, if you have children that are of age that can contribute to your business, be it through cleaning, paper shredding, or marketing, right? If they could run your social. So if you have children that can contribute to your business, can you set up IRAs for them?
If you put them on the payroll and they technically have earned income, then yes, you can start Roth IRAs for them or some type of investment account, which is great and gives them a head start.
Okay, and is that, I said 3 years was for my company when folks are vested for that. Is that standard? I don't remember, or do you have the flexibility?
You could, 3 years is pretty standard.
Okay.
That's, yeah.
But it's not required.
The longest you can wait is 3 years.
Okay.
It is required. Absolutely. It is required 3 years.
Okay, got it. I got it. Okay, I've got one more here. How does life insurance to fund a college compare to using an IRA to fund a college? Or what would be your advice? If it's look, I've got some money to fund college, I could either buy a life insurance policy on my child or myself, or I could go into an IRA fund.
Typically the life insurance policy, if the child is age 7 or younger, will be more efficient, tax efficient. It also depends on how old will you be as a parent when your child is in college, because you don't want to have to pay tax penalties for taking money out of an IRA early.
Okay, that makes sense. That's why I know it's so circumstantial.
Correct. Yeah.
How old are you? How old is the child? I mean, there's just got to be. It's hard for you to advise on such a.
Yeah, and I am here as a resource if anyone wants to reach out. If it's a brief phone conversation or you just want to double check some work, I will do whatever I can to help. If it evolves into something more formal, then great. But I do just little free consultations, one-offs all the time. It's just kind of what I believe in.
Well, thank you so much. We will be sure to include contact information to Tom in our follow-up email to all of you guys, so you can connect with him if you'd like to. Last question, and then, gosh, we timed this out perfectly, so we've got one more. So great question from Karina. So she says, with regard to paying tax in retirement, okay, right? We are told all the time that it's better to pay taxes in retirement because our income is lower, right? So yes, that's true. But what if your income would potentially be higher because of residuals from businesses, paid off properties? Like, how would you plan for something like that?
Well, in our financial planning software that we use, we project all of that out. So I'll just say that whether you're 22 in planning or you're 65 in planning, we can project all the way out to age 100, and we can factor in growth in property. We estimate income taxes, and so we can see what that might be. And then because of those projections, we'll take action to try to mitigate that as much as possible with various strategies. And again, it's specific, but that's a great point, because it's not just about today, it's what's maybe coming down the road here, and how will we offset that if we are in a higher tax bracket? What might we do? And then we can show maybe doing SEP IRA to Roth IRA conversions, paying the tax burden, and then we have more tax-free income. So there's a lot of different things. You want to reduce your required distribution at age 72. So at age 72, you know, it used to be 70 and a half. Now at 72, if you have any money pre-tax and IRAs or 401ks, the government says you have to take out about 4% per year, even if you don't need it. You're paying tax. We want our tax revenue.
Right.
Well, a lot of people don't like that, but it's just, it's the rules and the laws. And so we have to, there's so many things to plan for, and we are very nitty gritty when it comes to all of that. And anybody who says I'm a financial advisor, I'm a financial planner, has that software and ability to project and do that for you. And there's so many competent, great folks in San Antonio that people can find to work with.
It's true. Ours has every bank account we have, every investment, every credit card, like tied into what we call the vault. And so there's like a real snapshot of where you are financially, looking at businesses, assets, accounts, it's all there. And so that's what Tom's saying, that everybody has that. So that's great. Okay, another great question. I lied. It was about, what would you suggest on a college saving for a kid that's about 14? You know, I mean, you've got a small window, in other words, right? Like, what can I do in the next 4 to 5 years?
And if you're pretty certain they will be going to college in some form, a 529 plan, it would be the best in that scenario. And do not pay any A like Apple, A share sales charge commissions to a broker, because you don't have time to recoup that. So you would go with a C share, a C like Charlie, or go find some no load Vanguard 529 plan. You cannot afford to pay charges if you only have a 4 or 5 year window.
Awesome.
But a 529 plan would be the route to go.
There you go. All right, you heard it from the man himself. Tom, thank you so much for taking time to share with us. Like, really appreciate it. And again, would love to get you connected with our members. And everyone, I just also want to thank Meritage Homes. Again, you can go see Laura out at Myers Landing in New Braunfels, behind Buc-ee's. And with 9 homes priced in the mid 250s to 300s, like, those babies are going to go like hotcakes. So we want to make sure that all of you have that information. So thank you to Meritage Homes, such a reputable builder. We are privileged to be in partnership with you. So thanks to everyone on the call this morning. We look forward to seeing you next time, and hope you all have a great rest of the day. Take care.